All right, so I wanted to do a video on lenders because this is usually the first step in the home buying process, and I think there's just a lot of misconception out there about the different categories of lenders. Well, I guess first of all that there are different categories of lenders, and then how they vary in practice. So a lot of people, when they're looking for a lender, they actually do so kind of separate from their realtor. A lot of times they do so before they even get their realtor. So they'll typically go on a website like bankrate.com, or they'll just in the Google they'll type in, a home mortgage lender or something like that, and they'll be directed to a site like bankrate.com where there'll be a whole list of lenders with the APRs they provided and the ability to click on those links, fill out the forms, and get pre-qualified with, or pre-approved, then pre-qualified with one of those lenders. Now, those typically are the first category of lenders, which I'll refer to as e-lenders. And these are typically lenders that don't operate in a sort of brick and mortar building. They focus on mortgage lending, or maybe mortgages and car loans, and they don't have a bank, typically a physical place that you can go into. So that keeps costs down, and they're typically, at least on paper, able to provide rates, APRs, that are lower than anyone else. And that's kind of their niche, that, hey, if you go with us, basically, we're the cheapest lenders around. So you're gonna get the best rate for your loan. And that, to a degree, is true. The downside of these types of lenders is that there is, I guess it's the same benefit or downside of all lenders. It's an incentive structure. So these lenders typically rely on a smaller staff. Again, they don't have buildings. They rely on a smaller staff, and a lot of these staff are going to be hourly employees, salary employees, rather than incentive-based like commissions-based. So at the end of the day, the incentive structure isn't quite there to provide them with the oomph they need to A, make sure they do a really good job throughout the process, and B, and this is the key thing, make sure they close on time. And that, for a lender, is the number one benefit of one lender over another. Can you close on time? In a market like this, where it's very much a buyer's market, buyers have, I guess, the benefit, the privilege, if you will, of being able to drag their feet, being a little bit more needy. In a normal market, in a seller's market, and even in some cases in this market, when you have highly desirable properties, the closing date is the closing date. A lot of times these closing dates are between 3 and 5 weeks out, and if you don't close on that, in most states, surely in the state of Texas, there are penalties. There are things that can go wrong, and you can flat out lose your property, lose your earnest money, and lose all the time and effort you've invested in getting to that point. So having a lender that can close on time is a key thing. Having a lender that does all the things in a timely manner, gets your appraisal done in a timely manner, gets everything necessary packaged together, and gets it to underwriting in a timely manner, so that we can close and we're not coming in the day before, the day of closing with, oh, by the way, we need these 5 documents, these 4 signatures, and then we have to start the underwriting process all over again as a result. That has happened, unfortunately, in transactions I've been involved in several times, and it's never good when it does, and in some cases it was a deal breaker. So the plus side with your e-lenders is the rate. The downside is there is a risk that A, they kind of flub the transaction, B, they delay the transaction, or C, you lose your property altogether because things take so long. So that's one category. Your second category is the most, I would say, common category to deal with a buyer who has already gotten a lender. A lot of times they bank somewhere, and when they're doing their search online, through cookies and things like that. People sell your information. It's the reality of the situation. And if once your bank is aware that you're looking for a home, they're going to start calling you, texting you, sending you promotional information in the mail. So if you bank with one of these large institutional lenders, Bank of America, Chase, Wells Fargo, there's about a half dozen of them out there, you can be sure that when you start to look for a home, they're going to let you know that they can help you out with a mortgage, and a lot of times they can also provide you with just X dollars incentive to close on the property. A lot of times these large lenders, they have money to throw around, so they'll just give you cash. They'll say, hey, if you close with us, we'll give you three grand towards closing costs. We'll give you $6,000 towards closing costs. And that is super enticing to a lot of buyers. The downside is the same downside with your e-lenders, is that the incentive structure isn't there. The staff that is typically working on these loans are, again, typically hourly salary employees, and they don't have the incentive structure to go the extra mile to make sure everything is done on time. There's a lot of moving pieces as it comes to originating and underwriting a loan. I'm actually a licensed MLO, so I have at least a degree of knowledge in this industry to tell you. There's a lot that goes on. There's a lot of moving pieces. There's a lot of documents and things that need to be just so to make it so that that lender feels good about funding your property. Without the incentive structure there, and with these banks that do billions, tens of billions, hundreds of billions of dollars a year, your little mortgage, quite frankly, doesn't mean a whole lot to them. That's the unfortunate reality of it. So when you remove the incentive structure, you can put yourself in a disadvantageous situation. And that's the downside of those lenders. So upside is incentives with your large institutional lenders. Downside is the incentive structure to make sure that they can close on time and get everything done in the right way. The third category is my favorite category. This is your local in-state specialists. These are your local mortgage specialists. Typically, all they do is mortgages. That is their bread and butter. You have often a very experienced, very knowledgeable, and very responsive loan officer who would be working with you. One big local one here is Supreme Lending. I've worked with Fairway Mortgage, Revolution Mortgage, Integrity Mortgage. There's a Guaranteed Rate is Coldwell Banker's preferred lender. I've worked with all of these lenders, multiple transactions. Willow Bend Mortgage is another one I've worked with, and they do a great job. And often they can be very competitive with their rates. They don't typically have the incentive structure that your large institutional lenders have, but what they can do is not only are they going to make sure that everything is done perfectly and in a timely manner, they can make sure that everything is set to close on time, or in some cases early. Typically, it's only these local lenders that can close in 3 weeks, or sometimes even less. If the need arises, if you getting a property means closing in a really quick amount of time, your local lenders are the ones that will get it done. They're typically the only ones that will get it done because the incentive structure is there. And so they're by far my favorite to work with. They're the easiest to work with, and they're the quickest. And often the person that you can reach out to 7 days a week is the most knowledgeable of the bunch. The last is a smaller category, but still a significant one, especially in this market, is the builder's preferred lender. Now, every large builder, whether it's a statewide builder or a national level builder like Lennar, D.R. Horton, Megatel, so on and so forth, they have their own in-house lender. So there's definitely an incentive structure for them to work together because the corporation as a whole benefits because they're getting revenue from loans as well as from the properties that they sell. Often these lenders can give excellent promotional rates. They'll give you a low interest rate. They'll give you cash at closing. They throw the kitchen sink at you. Now, due to lending practice changes that started happening this year, that incentive structure is starting to be pulled away from these lenders to kind of put a line in between what is maybe a too overly friendly relationship between the builders and their own lenders to make it more of a level playing field for everyone else. But while the getting's good, these builders lenders can often offer incentive structure that no one else can beat. And since it's the builder's lender, right, the builder understands that, hey, if things get delayed, it's our lender, we're going to wait around for them. So it doesn't kill the deal. So when you're looking for a home, if it's a new build, look at your local lenders, but also see what those builders lenders can get you. Apart from that, if it's a resale, if it's existing construction, I would definitely encourage you to, if you've got your own lender, maybe you've worked with it in the past, great. But I would also encourage you to get pre-qualified with a local in-state lending specialist. That's the rundown I have for you. I hope this helps. If you have any more specific questions, feel free to DM me, like and subscribe, and I will see you on the next video.